So the most significant change in global markets over the last year has really been central bank activity around the world. And what we're finding is that there is a big divergence in terms of the way that central banks for Europe, for Japan and for the US are actually acting at the moment. So in the US, we're starting to see that they are removing stimulus because economic activity is picking up and the central banks don't need to be pumping more money into the system as that activity starts to pick up. Albeit that the Federal Reserve in the US probably hasn't been satisfied with the fact that their quantitative easing program hasn't done much for the real economy to the extent that they would have liked, but it's certainly boosted asset prices. It's provided a lot of cheap money and easy money for investors to basically access and put into the marketplace. Now going forward, that's not necessarily going to be the case, and that's why that they are starting to remove that stimulus. But when you're looking at Europe are in a very, very different situation. They are faced with lower inflation, almost to the point of deflation, which they need to actually manage. And getting growth out of the sort of doldrums that they're in Europe is a very big structural problem at the same time. So the European Central Bank has to do a lot more lifting in relation to trying to get activity spurred on. The main global drivers for markets over the course of the last sort of 12 months has really been the fact that there's been cheap and easy money available to investors. Now this is primarily in the US where interest rates are basically zero and that there has been a lot of liquidity pumped into the banking system. So the rich have certainly gotten richer over the last sort of 12 months because they've been able to access credit and put it into the marketplace and actually generate some really decent returns as a result. Now, when we're starting to think about what are the other main drivers for the markets over the last 12 months, biggest buyers in the marketplace has actually been the companies themselves. So close to $600 billion has essentially been put into the US market because companies have bought back their own stock. Now this buyback program is not necessarily something that's going to continue into the future, but it certainly has been a major contributor to market performance over the last 12 months. The Australian economy has basically shown some signs of strength over the course of the last sort of 12 months, but a lot of this has been export related. A lot of our exports go up to China. It's what we dig out of the ground and what we send up north. Now, China is still going to be a big buyer of a lot of our mineral exports. And in fact, they're going to be an even bigger buyer of our agricultural exports as well. But that's not the only sort of dynamic that is affecting the Australian economy at the moment. Domestic demand is actually quite weak in the Australian market. And the Reserve Bank have to be in a situation where they're managing the sort of slowing mining expenditure and investment against what's happening in the domestic economy for retail sales and for capital investment. Now that's a very, very different and it's a very difficult dynamic to be able to manage going forward. So the Australian economy hinges on the fact that China still needs to buy a lot of our exports, and the Reserve Bank then need to sort of set interest rates that's going to actually spur some activity in the domestic marketplace. The problem that the Reserve Bank have is that they've still got a very high currency. Now, a weaker currency is going to lead to greater economic activity in the domestic market. But at the moment, because our assets look so attractive, being property and bonds, you know, foreign buyers are basically sapping into those assets and they're supporting the Australian dollar in the process. So it's a very, very difficult dynamic to actually manage. But for the Australian economy, we are in a position where domestic activity is reasonably weak. We've got a big gap in the fact that our mining investment is not going to continue, and we've still got a reasonably high currency because our assets look cheap to foreign buyers. Our market is mainly or primarily banking and financial sectors and resources. Resources is a global phenomenon. It has nothing to do with the Australian strength or the Australian growth. It is much more akin to what's happening around the rest of the globe. And when you start to see that Chinese activity and growth is starting to slow from breakneck speed, albeit, but it is still starting to slow, then that's going to affect the Australian investors in terms of some of the resource companies that we have on our market. The banking sector is very, very solid, and we're in a position that they're still paying very, very good dividends. And if you start to see more risks being priced into global markets, we will absolutely see that happening here. And that's one of the sort of key factors going forward. We need to sort of look at the way that markets are positioned. So markets around the world have really been starting to price in really good economic activity going forward. If that doesn't happen, then there is a risk to markets. Companies themselves have been driving their earnings results due to cost cutting and buying back their own stock. Our expectation is that the markets will probably trade sideways for probably the next 6 months and only start to look into 2015 to see whether or not that economic activity is going to translate into higher revenues for companies. And then you have a transition effect. So what happens is that earnings will transition from cost cutting to more revenue growth, driving their earnings profile going forward.